Welcome to our daily Forex market analysis for Wednesday, March the 6th. Now, as we are approaching the release of the U.S. non-farm employment numbers on Friday, it was correctly pointed out by Craig, one of the moderators on our trade floor, that this is the latest day in the month that we would typically see this report come out during the month. And of course, the U.S. non-farm employment seems to have the greatest impact in the marketplace and create the most volatility during the calendar month. But because the first of the month was on a Friday and the release is not coming out to the 8th, this is the deepest that we've come into the month to see this report. So it's having a curious effect in the marketplace. It seems to have really kept the currency pairs in check, and most notably our volatile pairs, or our focus pairs, which have been the yens, have really been out of step and been doing more of a consolidation than anything else. We have now the euro yen and the pound yen are still in a transitional mode, but they're consolidating and they're really at a period of uncertainty, and we'll look at that just a little bit. If you look at the currency strength chart, you can see clearly marked here in green, you'll see that the dollar has been the currency with the greatest amount of strength. Now, it's a little bit strange because the dollar not only is running up a couple of days in front of the non-farm payroll, but the expectations, the forecast, the prediction, if you will, for the non-farm employment change is actually very low. It's at 161 or 165, somewhere in that range, depending on which report you're looking at and which bunch of analysts that you're whose numbers you're gauging that by, but we're in the 160,000 range last month at 157, so very much in line with where we were last month, but still drastically below that minimum level of 250,000 we would need to see real growth of jobs growth in the United States. So the dollar moving up in front of that, the report expectations aren't that high. You could look at it from one side of the fence saying, well, the expectations so low it would be easily beat. The flip side is this has been the level it's been coming at the last few months. It's just not enough, and so I think that we would anticipate that if the report is less than expected and if the dollar continues to run up on Thursday, then your opportunity to see the dollar trade lower on Friday and maybe take advantage of some long, euro dollar, or ideally I think pound dollar has been the best trading pair this week. And that may continue on Friday. So if we see a dollar that wants to pull back after the report comes out on Friday, that pound dollar, assuming that the pound has some strength to it, may in fact be one of the best plays in the marketplace. Look at how the pound, speaking of, in pink here, is trending to the downside, but it's not very far down. Fairly sideways, but it is on the negative side of the midline. You see the Swiss is down to the lower end, still rather flat. You can see the euro is in red here, is also laying pretty flat on this chart. So other than the dollar moving up, the rest of the currencies are really moving sideways. Saw the Aussie get a little bit of a lift, and you can see here in orange the Aussie's been tracking sideways since then, but still the level that it's reading on the CCYX is not that great. So I think the dollar is probably setting itself up for a pullback. Hopefully that will be the case. There's absolutely no guarantee, but again, expectations are low. It could exceed expectations. That would be considered a fundamental positive. If it doesn't exceed those expectations, 160, 165 is a pretty low number, and that would be hugely disappointing, and then we would look for the dollar to be trading down from a fundamental standpoint at least, and the potential for a pound dollar trade could be real, and a good one at that. Now let's look briefly at the euro dollar here at the bottom left-hand corner of this 4.4 chart view. And you can see that it really is fairly messy. It's trying to maintain an upward trend. We've had divergence between the dollar and the yen. The yen has been trading down. That's helping push this pair up. But remember from yesterday's review and the prior reviews, what are the levels that we're looking at that it needs to achieve in order to look long or short? And we've been talking about that 122 range would be ideally the top of where we would want it to go if we're wanting and preferring to see a short opportunity, and that's exactly where it's at. It's at just over 122 right now. It's been a little bit higher than that with this little burst move when the yen shot down and got itself up to 122.25. That takes it on the trading high that we saw just a few days back. And so this is still testing that range. It hasn't done anything significant to move to the upside, but it is at that resistance line. And remember, we're at a resistance point. Instinctively, you want to, and it's definitely most traders' instinct when we get to a resistance level that you want to take things long. And we get to a support level, we want to take things short, when it really is just the opposite that we should be considering. This pair is overbought. You can see a little overbought level here in the oscillator. It's at a resistance point. If we don't see some continued yen weakness, if the yen gets any strength, and the yen has been showing, overall has been showing strength since about the 12th of February, then this will in fact create a great shorting opportunity. It's not there yet, but it could. If the yen does continue to move down, if we see that, then this would get over that 122 and maybe the 1 to the 123 range, and then we start to have some good opportunities for longs as it goes back into the original consolidative or the transitional range, and we could look at that to maybe even trade as high as 127 or above, which was the high we saw just several weeks back. If we look at, I've got to tell you, I still would prefer to see this pair go to the downside, because I think it has much better potential to the downside, but it doesn't really matter to me as a trader. I just want it to move, and right now I don't think the yen pairs are moving. It's surprising. This pair's average daily trading range is over 250 pips. It hasn't been doing that for the last couple of days. You can see the same thing on the pound yen here in the bottom right hand corner. Now it's the opposite, because the pound has had weakness overall and the euro has had some strength over all. The pound's maybe still reeling from the Moody's downgrade to some degree. A little bit of volatility again. This is that sharp move that we saw in the yen just before rollover. But this is fairly lackluster as well. Pretty choppy. A lot of red and green, red and green, red and green. When we're looking at pure price, when you're using range bars, the clarity difference is substantial, but seeing a constant fluctuation in red bars to green bars, red bars to green bars, really shows us that there is no true direction. So this is a consolidation. This is an uncertain market, and again, in front of the U.S. non-farm payroll, that is to some degree to be expected. But think about what we talked about yesterday and looked at. The trades I made yesterday were on the pound dollar, and the pound dollar, you can see, still has been the pair in play. Now it's moved too much. It needs to retrace a little bit. It's coming into the zone. You can see this has made a nice move from about 151.60 to the upside right here after roller. 151.55 I guess is the top, and it came down all the way to 149.66. So it's about 200 pips that it's dropped in the day yesterday from rollover to rollover. So that's a good opportunity. It's easy to make some money on a pair that moves by 200 pips in a single day. You see one substantial lower high along the way, and now the pair is going back into the zone. Arguably could in fact create some type of opportunity. Dollar keeps going up. If we continue to see dollar strength overall, then this will continue to be a more than likely a short opportunity, just not yet. Again, look at the oscillator. It's oversold. Pair prices retracing back. This is an odd duck time of day. As we get closer and closer to London open, this could in fact create an opportunity. But then what's really our expectations as we go into a Thursday in front of the non-farm payroll? I always think that maybe there's nothing to do on the Thursday, although some Thursdays surprise us, and then we look to make back those pips, things that we think we should have been able to make during this week on the Friday during the release. Now, some of the releases as of late have not been that outstanding, but that's always has the ability to change in any one non-farm payroll, or lack of the volatility in non-farm payroll does not a trend make. It just means there was 1 month or 2 months where we didn't see the same type of explosive activity or volatility that would come to associate with the NFP release. You know, as the number comes out, just remember, patience and discipline is really the name of the game. We want the release to come out. We want it to be disseminated in the marketplace. We want to see how the herd is reacting to it. We want to anticipate the possibilities, and then we want to act. We want to give the overall market a chance to make the move before we just go start throwing dice up against the wall to see if we can score. I want to take a calculated risk. So for the rest of this week and leading into the non-farm payroll session, it really is going to become more so than ever. This is where you really have to exercise patience and discipline. For some of you, maybe not even trading makes a lot of sense, and for others, the most simplistic thing to do if you are trading is just to reduce your trade size and or your expectations, and at minimum reduce the expectations, because we're not going to see, more than likely, we're not going to see any explosive activities on a Thursday, although again, sometimes it will surprise. When you have lower volume and less transactional activity, what comes in the market can have a greater influence. We see the same thing on major holidays. We have much lesser volume, but we can see some volatility spikes in there because I always say traders rule on 3-day holidays, because the institutional players typically do not trade on those days, or not anything with substance. So the individual investors can come and traders can come and kind of rule the market. But since they never always move that sensibly, the volatility spikes can be pretty wild. And if we're going to see anything, it's going to be something of that nature tomorrow. But I do tend to doubt it. I do like the fact the dollar is rallying up. I think that does set up an opportunity, especially if the numbers miss. And I think that would be, from a fundamental standpoint, would suggest that the dollar would come back down and the long plays would take over. If it exceeds, because the expectations are so low, what I just said, then the opportunity for the dollar to fail and come down on a bad report and rally, if it can achieve or break these mild expectations to the upside, then we have a positive dollar situation, and then the short trade comes in play, and that is really what I'd like to see happen. We've got this thing coming into the zone. It's almost in an attractive point. We just need to see it get a little bit more neutral, or even slightly overbought on the oscillator, and a little consolidation, just it moving sideways for the next few hours and going into the London, could solve that problem. So that's really not a concern. So again, exercise some patience, exercise some discipline, reduce your trade size and or your expectations, proceed with a very high degree of be suspect of what's actually happening out there, and in some cases it might even be better to wait and go into Friday, let the numbers come out and let the actual data be disseminated, let the initial knee-jerk reaction pass by, and then you might choose to get involved in some of the trades. Right now it looks like pound dollar may be one of the better opportunities. It has been so far this week, but that could change at any moment. So if you've got some questions, you can post them on these videos. I'll answer them in a future video. If you want to spend some time with us, you want to trade these markets live based on not only the analysis I'm doing now, but what we do as a group every day during live market conditions, you have an open invitation. Look at the email address on this video. It's info@fxrbc.com. That's info@forexrangebarcharts.com. and we'll get you an invite. We'll send you a questionnaire and get you an invite. We do have a couple guest weeks coming up, and we'd love to have you with us. Click on subscribe at the top of the page so we can stay in touch with you. We don't send very many things out, but when we do, want to make sure you're on the list to receive those. And if you want more, just let me know what you're needing and the questions that you may have, and I'd be more than happy to help you. My name is Derek Schimming with ForexRangeBarCharts.com. As always, you guys and gals, have a great day trading.